we're back, guys. You're listening to Benzinga's Pre-Market Prep. I'm Brianna Valesky here with Garrett Cook, and we have Dr. Mikhail Melnik on the line. He's a Bloomberg economist as well as a professor at Kennesaw State University. Dr. Melnik, thank you so much for joining us this morning.
Thank you. The pleasure is mine.
So, of course, we have to start with the Fed statements this week. I mean, they removed, you told me the other day that you felt the Fed is fairly predictable at this point. They removed patient from their statements. What are your expectations as far as an interest rate hike?
I like the way you said it. They removed the patience from the statement, and everybody says that. And yet, the bond rate dropped after the statement. So that's a little bit interesting, right? On the one hand, they removed the part about being patient from the news release, and yet they appear to be more dovish than before. So I don't pay that much attention to the individual statements as much as to the policy nature. And I think the chairperson, Janet Yellen, did actually a very good job at the press conference. She basically, yes, they removed the particular statement about being patient with the rates over a longer period of time, but she also said that she reiterated the point that the policy responses to the economy, not the other way around, and or not at least it shouldn't be the other way around at this time. And so basically, even though there is no statement on impatience, the Fed indicated that should the economy need additional help, the Fed is willing to provide it. And I think that was seen throughout the press conference. And my opinion on the interest rate outlook for the United States remains unchanged. I indicated that in my CNBC interview a year ago. I indicated that in my forecast back in 2013 and 2012. And this remains the same. I continue to expect our rates to remain roughly where they are throughout the rest of this year, and actually throughout probably at least the first half of next year. And there are a number of reasons why this is the case, one of which is the weakness in the global economy. Another is actually a relatively moderate growth in the U.S. But I guess that's a separate topic, so we can get to it whenever you like.
So, if you're not seeing an interest rate forecast and you're looking at the U.S., I got to ask you a little bit about what's going on in Europe too, because we have a whole bunch of central banks taking action. But what I really want to look at is in Europe. We were talking just before we brought you live about a Citigroup note that came out yesterday, and I want to get your views on what you think about having to, Citigroup suggesting that Europe takes all the national central banks and put them all underneath one cap, so they'd essentially become branches of the ECB. And it looks like they're going to need to kind of do some fine-tuning to their monetary policy. I'm sure you don't want to argue with Citigroup about it, but do you have any comments on what is, the fact that where you're going to have to re-engineer monetary policy and monetary unions, just in order to what seems to be, kind of hide the debt, keep the music playing, if you will.
Well, first of all, I wouldn't argue with Citigroup. I think they're doing a great job, and certainly their assessment is correct. The European Monetary Union has one currency. So technically speaking, the authority to print money belongs with one bank, and that is the ECB. So the point of having the other banks being independent is already sort of mute. So the question is simply how you restructure it so that the ECB authority is enhanced and the system is more predictable and more transparent. That's in essence, I think, what the Citibank is saying, and as an economist, I can't possibly argue with that. So from that perspective, yes, I completely agree with that. In terms of, and again, one money requires one manager. Having 27 different managers over one currency is a little bit strange. So ultimately, I remember hearing this term back a few years ago when the European Union was creating its currency, that it would look a lot like the United States of Europe, in essence. And that's not such a bad thing. In fact, that's economically a good thing, because you're creating a more simplified system for people from different countries to trade with each other, to invest, and so on and so forth. So these steps, these simplification steps, are, in essence, necessary along that path. In terms of what goes on in Europe, Europe is helping us right now in the United States. I want to take us back to the United States a little bit. I know that the European Union is an exciting place right now. The monetary policy in Europe is in full speed right now, and so that's where the action is. And we see that in the euro versus U.S. dollar exchange rate. But I want to take us back from Europe to the U.S. for a second. One of the reasons why I think the outlook for the United States interest rates remains low is because Europe is weak. Because we see these weaknesses overseas, those weaknesses are actually very interesting right now. They're strong enough to boost the value of the dollar and to weaken commodity prices, both of which helps us. And it helps us actually in the trade balance rather nicely because we're still buyers of commodities, and when those prices drop, the value of imports declines. But at the same time, those weaknesses are not strong enough, which is good. They're not strong enough to actually bring a recession to us. In other words, they're not strong enough to cause a severe enough pullback in our own economy, because through trade or through investment, it is possible to translate recessions. But they don't have an outright recession to cause us that problem. So I think the European Union right now is helping us as it tries to address its own problems. And going back to the European Central Banks, I think I mentioned to you back a couple of months ago at our earlier discussion that I think the problems in Europe are rather severe. The problems associated with the national debt of Greece and other countries, and that requires a more fundamental restructuring. But again, that's a different topic. So.
Dr. Melnik, I'd love to get your take on, we had a guest the other day who says they think the ECB is making the same mistakes as the Fed did by bailing out the finance industry. The financial industry. Do you agree with that?
First of all, I never said that the Fed made a mistake bailing out financial firms. I don't consider that an error.
Someone else made that comment.
If you read, let me explain this briefly. If you read my book, the one I published about a year and a half ago or so, I am a bit critical in it about the Fed. But I criticize the Fed for missing the crisis. In other words, I criticize them for not seeing the economic data coming out in 2007 that showed severe declines in residential investment in the U.S. So that basically was painting the picture of an economy that was on the verge of some sort of storm. That's where the Fed failed. The Fed tried to bail out the housing market in September, even though that was a cyclical market that required help prior to the summer. But I never criticized the Fed for bailing out financial institutions, even though I recognize as an economist that causes moral hazard. I recognize that. I understand the platform that some people take when they say the Fed's behavior creates the potential for a bigger crisis later on. I understand that, but I also understand that our economy relies on the financial structure. At some point, major financial firms like AIG, for example, become not only a business, but rather the infrastructure of our financial system. And at that point in time, bailing out such entities becomes a necessity. If you don't, you risk having a very severe acceleration in the crisis that may potentially damage the economy even further. I understand that when you bail them out, you create moral hazard. So from the long-term perspective, that is better. But that's where I tend to agree with Keynes, who said in the long run we're dead, meaning that you got to survive the short run. And if in the short run you allow major infrastructure-like enterprises, the enterprises that actually can create the financial infrastructure to collapse, then you will have a very severe investment pullback, which will translate into consumption pullback and across the economy. So I don't blame the Fed for that. In fact, I believe that the Fed did a rather good job at putting out the economic firestorm. Where the Fed failed, in my mind, was they didn't act as a good enough watchman to prevent the firestorm from happening. So when the ECB takes the position of bailing out large financial institutions, Well, but what option do you have? The other alternative is to let them fail. They fail, they create a liquidity problem in the economy, investment falls, unemployment rises, and where do you find yourself? You find yourself, in essence, bailing all the victims of that collapse. So from that perspective, even though it sounds unfair, because you're bailing out an enterprise that failed, and in a market-based economy, the logic is that he who fails should pay the price, and here you're bailing failure at the expense of essentially taxing to bail out the failing enterprise. You tax those who didn't fail, and so it's an unfair decision in that sense, but it's a necessary decision. If you don't do that, then you will have to bail out all the victims, and there will be a magnified effect. So I wouldn't criticize the ECB for that. In fact, my bigger concern with our economy and the European economy is not the behavior of the central banks. The central banks seem to be doing what they're supposed to be doing. My biggest concern is on the fiscal side. The level of national debt here in the United States, the level of national debt in Europe is relatively high, and more importantly, it's rising. For example, going back to, again, the United States interest rate structure, our national debt has surpassed $18 trillion. Our economy supposedly is doing well right now, although I believe that this is going to be a decent year, between 1.9 to roughly 2.5% growth. That's good, but that's not very good. But even with this growth we have right now, we can't seem to get out of budget deficits. We only had, I think, in the last 4 or 5 months, 1 month of surplus, and that was December. That was extremely tiny. So we continue to experience budget deficits, even in a good economy. So our government continues to fiscally stabilize and expand the economy. And with that in mind, how can you reverse the monetary policy? What would you accomplish? How would you increase the cost of borrowing for the government sector? So to me, the central banks are not the issue, neither here or in Europe. To me, it's the fiscal policy that sort of runs, that sort of gets out of control and operates under the assumption that the monetary policy later on can bail it out, or higher taxes later on can bail it out. And that, I think, is dangerous, and that, I think, can act as a deterrent to economic growth. But again, my concern is with the fiscal side, not the monetary side.
So, I mean, we got a few minutes left, and you're talking about the fiscal policy stuff, and that was a question that I wanted to ask you, actually, is are we beginning to transition from a period where the central banks are designed to aid just the financial sector, the monetary policy system of each of these independent nation states? Are we starting to come to a point now where a central bank is kind of an offshoot of a government, a way for it to put debt off its balance sheet? Because if I go back and I take a look at U.S. debt issuance, I actually did this and went back to 1988, and you average our 10-year yield, it comes out to about an average of just a little over 5.5% if you take it from 2015 back to 1988. And if you take a look at our ability to actually meet our interest expense, we started falling behind on that ability in about 2002. So we've had a greater problem in the U.S. of being able to meet interest expense payments, and with rates so low, nations are actually being forced to take on a larger debt issuance level over a shorter maturity period with a lower interest rate. And it seems like the longer that we prolong this, the more pressure that's going to be put on sovereign nations that actually give central banks the power that they have. So are we coming into a state now where a central bank's not necessarily just trying to save a financial sector, but it's actually going to hold together the entire world economy? I mean, do you expect to see central banks doing whatever they can in order to save federal systems?
You're raising so many questions that probably I teach a class in intermediate macroeconomics, which sort of covers half of what you said in an entire term. So in the remaining minutes, I'll try to address it in the following way. First of all, the U.S. Treasury is much more intelligent, and it has been shifting some debt to longer maturity terms at lower rates. They're called PICs. So they've been doing that. That also generates tax revenues as those PICs advance in value. So the U.S. Treasury has been taking different steps to resolve the issue. secondly, I agree. In other words, the question is, can a central bank be truly independent in a nation whose debt starts to drastically increase its income, in other words, its GDP? So in that sense, I don't believe that our central bank is fully independent in that sense of the word. In other words, it has to pay attention to the level of national debt in order to, when it makes its decisions. And we can see, for example, let's make a hypothesis. Let's say that the Fed raises the federal funds rate, right? Well, what would happen to the yield curve? Potentially it can flatten, right? Because it will create lower inflationary expectations and bring down long-term rates. So depending on how the national debt is structured, the effect might be different, right? But I do agree with you that the independence of a central bank is affected by the level of national debt. National debt generally presents a serious issue because it will either lead to some monetization of that debt over a longer period of time, or it will lead to significantly higher taxes. Now, all of that can be avoided if you have extremely high productivity growth. In other words, if companies like Google provide us with magnificent new technology, then who really cares, right? If one worker can produce the value of output produced today by 10, then what's the question of national debt? What's the question of social security issues? They don't exist. But if such robust productivity growth does not occur, then yes, you will have higher taxes, you will have lower real interest rates, you will have issues associated with meeting that debt requirements. And you already see that in some countries. So, ironically, we keep talking about the U.S., but there are other developed economies that have far greater debt to GDP ratios. Japan is an example. So, that is an issue.
We've had Dr. Mikhail Melnik on the line. He's a Bloomberg economist as well as professor at Kennesaw State University. Dr. Melnik, we always appreciate you joining us in the morning. You have a fantastic macroeconomic outlook and you give us a ton of insight. So thank you again. We will have to bring you back soon, and you have a great day and a wonderful weekend.
Cheers, Professor.
Thank you.